Every global superpower in human history has shared the exact same fatal flaw. They all believed their empire would last forever. They believed their military dominance was unchallengeable, their economic growth was infinite, and most importantly, that the world would always accept their paper currency as a guarantee of value. And as being Ting, but history has written a completely different script. And as being Ting, imagine waking up to a world where the currency you use to pay your mortgage, buy your groceries, and measure your net worth is suddenly rejected on the international stage. Imagine a scenario where countries around the globe refuse to settle trade in US dollars, causing a massive tidal wave of trillions of paper notes to flood back into the American domestic economy. The result would be an overnight hyperinflationary shock that would instantly wipe out the purchasing power of the middle class. And as being Ting, this isn't an apocalyptic conspiracy theory. This is the exact mechanical warning issued by billionaire macro investor Ray Dalio, the founder of Bridgewater Associates. Through his extensive historical research into the rise and fall of empires, Dalio discovered a predictable, repeating 500-year pattern. And according to his precise mathematical metrics, the United States dollar has entered the final, irreversible stage of its life cycle as the world's dominant reserve currency. And as being Ting, to understand why the dollar is in jeopardy, we must look at how the global economic machine actually handles the currency of empires. Ray Dalio's book, The Changing World Order, outlines that before the United States dollar, the British pound was the undisputed king of global trade. Before the British pound, the Dutch florin controlled the world. Each of these currencies enjoyed a long period of absolute hegemony. Because their nations were the dominant trading powers, international banks and foreign governments held their cash as a safe haven. Holding a reserve currency gives an empire an incredible, almost unfair privilege. It allows the nation to borrow massive amounts of money from the rest of the world and pay it back by simply printing more paper. And as being Ting, but this privilege always leads to the exact same trap. Over time, the empire accumulates far more debt than it can ever realistically repay with actual economic production. The politicians and central bankers become addicted to cheap credit. They expand their military presence overseas, fund massive domestic deficits, and live far beyond their means. Eventually, a tipping point is reached. Foreign creditors look at the massive mountain of debt and begin to lose faith in the empire's ability to maintain the value of its currency. They realize that the debt can only be paid back with diluted, devalued paper. And as being Ting, this is the exact structural trap that the United States dollar is caught in today. Look at the data. The global share of US dollar reserves held by foreign central banks has been steadily declining for over 2 decades. Major economic powers, led by the BRICS bloc including China, Russia, India, Brazil, and Saudi Arabia, are actively building alternative financial architectures to bypass the Western banking system entirely. They are settling multi-billion-dollar oil and commodity contracts in local currencies, and they are aggressively buying the only asset that cannot be devalued by a printing press, physical gold. And as being Ting, when foreign nations stop holding U.S. debt and stop using the dollar for international trade, the global demand for the currency drops. But at the exact same time, the United States government is forced to print more dollars than ever before just to service the interest on its $34 trillion national debt. This creates a catastrophic mismatch in supply and demand. You cannot expand the supply of a currency to infinity while its global demand is shrinking without triggering a massive structural devaluation. And as being Ting, Ray Dalio warns that this represents a profound paradigm shift. The investment strategies that worked perfectly during the peak of the American empire, such as holding long-term government bonds or keeping cash in a traditional bank, will become the most dangerous financial strategies of the next decade. In a currency crisis, cash is not safety. Cash is a guaranteed wealth destroyer. To fully grasp the gravity of this shift, we have to look closer at what Dalio calls the big cycle of debt and empires. Every reserve currency empire moves through an arc that lasts roughly 200 to 250 years. The cycle begins with a new world order, usually established after a major global conflict. The winning empire rewrites the rules of global trade and finance because it possesses the most dominant economy and the unchallenged military power. In the initial phase, the empire builds its wealth on solid foundations: high productivity, strong education, innovation, and low structural debt. This was the exact position of the United States in 1945, following the Bretton Woods Agreement, which officially tied the global financial system to the US dollar. In As the empire grows and becomes wealthier, the citizens become accustomed to a higher standard of living. Production costs rise, making the empire's goods more expensive compared to emerging competitive nations. At the same time, the empire must spend massive amounts of money to maintain its global military presence and protect its trade routes. To sustain this expensive lifestyle, the empire begins to borrow heavily from foreign nations. Because its currency is the global reserve asset, foreign central banks are happy to lend their savings to the empire in exchange for government bonds. This marks the beginning of the financial decay. Ray Dalio points out that this borrowing creates a dangerous illusion of endless prosperity. For a long time, the empire feels richer than ever, but its wealth is no longer built on real production, it is built on debt. The financial system becomes top-heavy. Eventually, the amount of outstanding debt becomes so large that the interest payments alone swallow a massive portion of the national revenue. When the empire faces an unexpected crisis, such as an economic slowdown, a pandemic, or a major geopolitical conflict, it faces a choice: default on its obligations or print the money required to fund the gap. One of the discreet with, throughout history, every single empire has chosen to print the money. They do this because defaulting on debt causes an immediate economic collapse, while printing money acts like a slow, invisible tax on the population. But this choice marks the point of no return for a reserve currency. When central banks print money to monetize government debt, they intentionally devalue the purchasing power of every single unit of currency in existence. Foreign creditors who hold hundreds of billions of dollars in the empire's bonds quickly realize that the real yield on their investment has turned negative. They are getting paid back in paper that buys less and less every year. This triggers the final, most chaotic stage of the cycle, a capital flight. Foreign investors begin to sell their government bonds and dump the reserve currency in search of safer alternatives. As they dump the currency, it floods back into the domestic economy of the empire, causing domestic inflation to accelerate. To combat this inflation, the central bank is forced to raise interest rates, but raising rates makes the government's debt payments even more expensive, accelerating the bankruptcy of the state. This is the exact feedback loop that destroyed the Dutch florin in the late 18th century and crippled the British pound after World War II. One of the discreet with, today, the United States is ticking every single box of this historical checklist. The national debt is growing at an exponential rate, increasing by $1 trillion roughly every 100 days. Foreign central banks, particularly in Asia and the Middle East, are no longer buying U.S. treasuries at the same rate. Instead, they are executing what Dalio defines as a silent de-dollarization strategy. They are shifting their reserves into tangible commodities, industrial assets, and physical gold. In fact, central bank gold buying has recently reached historic highs, signaling that the institutional players are quietly preparing for the end of the fiat dollar standard. One of the discreet with, the rise of the BRICS alliance is not a temporary political alignment, it is a structural challenge to Western financial hegemony. For decades, the US dollar's ultimate shield was the petrodollar system, an agreement where global oil could only be priced and sold in greenbacks. This created an artificial, mandatory demand for dollars across every nation on earth. But today, nations like Saudi Arabia and the United Arab Emirates are openly accepting Chinese yuan and local currencies for oil transactions. The structural floor beneath the dollar is being pulled away. One of the discreet with, when a paradigm shift of this magnitude occurs, the traditional rules of personal finance do not apply. Most retail investors are completely unprepared because they look at the world through a rear-view mirror. They assume that because the US dollar has been the dominant asset for their entire lives, it will remain safe forever. But Dalio urges investors to understand that holding cash or long-term government bonds in a devaluing currency is a mathematical certainty for wealth destruction. So how do you build a blueprint to survive the day the US dollar loses its absolute dominance? Ray Dalio's framework provides 3 concrete solutions for the ordinary investor. Wayne Dobb. First, you must aggressively diversify away from single currency dependency. If your income, your home, and all your investments are denominated in a single fiat currency, you are exposed to extreme structural risk. True diversification in the modern era requires holding globally diversified equities, companies that generate revenues in multiple countries and multiple currencies. When a local currency devalues, the nominal price of multinational stocks tends to adjust upward, to reflect the new monetary reality. You must look for businesses with strong pricing power, companies that produce essential goods and services that the world cannot live without, regardless of which currency controls the system. Wayne Dobb. Second, you must hold hard, unprintable assets. Ray Dalio has consistently maintained that gold belongs in every resilient portfolio. Gold carries no counterparty risk, it cannot go bankrupt, and it cannot be manufactured out of thin air by a central bank decree. When faith in fiat paper currencies collapses, capital historically floods into gold, causing its purchasing power to surge. In addition to gold, modern retail investors should consider real-world infrastructure, commodities, and productive real estate as anchors to preserve long-term purchasing power against the inevitable debasement of paper cash. Wayne Dobb. Third, you must focus on real-world utility and productivity. The ultimate protection against any currency crisis is your personal capability to generate value. An empire can rise and fall, and a currency can lose 90% of its value, but the global market will always reward highly productive individuals, essential businesses, and real-world problem solvers. In a hyperinflationary environment, your best asset is not what you own, but what you can produce. Investing in your own education, mastering specialized high-value skills, and building businesses that solve real human needs is the only investment that can never be inflated away by a government printing press. Wayne Dobb. The economic machine is moving forward exactly as it has for 500 years. The collapse of a reserve currency is not the end of the world, but it is the end of an economic paradigm. The middle class gets caught unprepared because they confuse the numbers in their bank account with actual wealth. They fail to see the difference between paper money and real value until it is too late. But those who understand the macro cycle, eliminate their currency biases, and position their capital into productive, hard assets will protect their families, preserve their freedom, and profit when the global system inevitably resets. Wayne Dobb.